Hi everyone, I'm Kathy Lee with BK Forex. So everyone is talking about the US debt ceiling. And by now you should know that if the debt ceiling is not lifted and the US defaults in its debt, there will be disastrous consequences. Not just for government workers and anyone who collects Social Security, but for everyone with an investment portfolio. Markets around the world would collapse, not just the S&P 500, but the DAX, the Nikkei, every market. And 401k retirement plans would be decimated. And that is why fundamentals matter as a trader. It is always important to have a broad understanding of how to incorporate fundamentals in your trade. But let's be clear, no one wants to be responsible for a government default. As much as politicians may push each other to the brink, their donors, their own investment portfolios, and their constituents would be hit hard by an all-out collapse of the market, which would happen if there's a US debt default, which is why I think it's very unlikely. They're going to push this to the 11th hour, but they're not going to let a default happen because it would be severe consequences for their own wealth, and they would have their constituents and their donors knocking on the doors. And that is why it has never, ever happened in the history of the United States. It is also why the market doesn't seem to really care. Stocks are hovering not far from its year-to-date highs, and the VIX, which is a measure of market volatility, is not far from its 2-year lows. Volatility is very low. And this past week, the US dollar saw its biggest weekly gain since February. Now, don't get me wrong. There is a lot of uncertainty in the markets, and that uncertainty will prevent any meaningful rally in equities and breakout in currencies or commodities. But there's a very low chance of a government default. With that said, there's a very high chance that Congress will push this to the 11th hour. And there's two very important and real risks that you need to watch out for as a result. Number one is a government shutdown. Number two is a sovereign debt downgrade by rating agencies. More likely than not, the US government will be shut down. Now, don't be alarmed. Most of us have lived through 1, 2, 3, 5, even 10 government shutdowns. And there has been 10 since the 1980s. And, this is important because while right now the market is not pricing in a default, if we get a US government shutdown, it can still drive the US dollar lower, significantly lower, stocks lower, and gold higher in a blink of an eye. And that is something that is the reason why it is extremely important to have stops at this stage, because that move will be significant, and to avoid holding your positions over the weekend, because oftentimes these announcements are made after the market close on Friday. So according to the table, you don't need to worry too much because stocks tend to underperform the week prior to government shutdown. And, that's not a surprise because of the uncertainty. But when the government is actually shut down, you can see from this other table that during the shutdown, stocks tend to be mildly positive because investors are anticipating a deal. But in the lead up to the shutdown, you do have to be careful because even though sometimes the V-shaped moves are erased quickly, there still can be significant volatility that can blow out your positions if you don't have the right stop. But 3 months later, investors have completely forgotten about the debt crisis and stocks are usually trading higher. As for sovereign debt or ratings downgrade, no one's talking about that right now, but that would be a big problem. But it has only happened one time, and one time ever, and that was in August of 2011. And interestingly enough, the US government was actually not shut down during that time, but the movements in the markets were severe. Dollar yen dropped nearly 300 points, or 4%, to its lowest level in more than a decade after Standard & Poor's lowered the US's credit rating. Eurodollar soared about 1% and then extended another % in the days that followed. Now, Europe was dealing with its own problems with sovereign debt crisis, so it fell hard by 9.5% in September. But, still, it did extend lower and it ended up, down quite a bit before bottoming out. The S&P 500 fell sharply in August and lost 17% in September. The cleanest move was actually in gold. After the ratings downgrade, we saw a one-way uptrend that drove prices up nearly 15% in a matter of weeks. And gold also benefited from the European sovereign debt crisis, and it broke up 1900, which I think at the time was a record high. It also U-turned in September, but despite the market turmoil and the concerns about global economic slowdown, because at that time everyone had a new fear, which was deflation. So S&P is not going to lower the US's credit rating again, but Moody's and Fitch still has the US's AAA, so they have wiggle room. A ratings downgrade would be very bullish for gold, as you saw in the earlier charts, bearish for the US dollar, stocks, and any risk assets. And that's something that we have to be aware of. Now, if Congress really fails to lift the debt ceiling, forcing the US government into its first ever default ever, the consequences would be severe. Moody predicts a 4% contraction in GDP and a loss of 7 million jobs. And even if the temporary restricted default, we could see 2 million jobs lost. Now, of course, that'd probably be temporary. Volatility, though, would go through the roof. Stocks would collapse 10, 20%. Gold would soar 20, 30%. And the US dollar would crumble, falling quickly and aggressively against all major currencies. The Japanese yen crosses would also tumble as investors bail out of all risky assets. It would trigger a crisis of confidence that would be 10, probably 100 times worse than the bank crisis that we just saw. And once again, no one wants to be responsible for that, because it would be a crisis of confidence that just would not just be what for right now, but it would put the creditworthiness of the US in jeopardy for a very long time. With that said, there's a 99.9% chance an agreement will be reached in the 11th hour, because it always does, right? And the debt ceiling will be increased. Since 1960, Congress raised the debt ceiling 78 times, 49 times under Republican presidents, 29 times under Democratic presidents. So it's not a big deal. It's really a routine, and has been routine in the past. The U.S. government has also run a deficit for as long as everyone can remember. In fact, the U.S. has been in debt since its inception, going as far back as the American Revolutionary War. There's only been one period that the U.S. government has been debt-free, and that was 188 years ago, in 1835, during the Jacksonian era, and it only lasted 2 years. Like too many average Americans, the U.S. government spends more than it takes in, and to make up for the difference, they take on debt and they borrow money. That's not a problem if you're considered the most creditworthy borrower in the world and everyone is willing to lend to you in perpetuity. But if that is not the case, then it becomes a really big problem, and finding borrowers becomes much more of an issue. So that is why politicians will do everything in their power to ensure that the status remains. So while the risk of a debt default is low, the debt ceiling in the crisis is still dominating headlines. And for now, the price action tells us the investors, don't see an imminent risk. But, government shutdown and this being drawn out is still a problem, which is why, it's important to be nimble with your positions, important to use stops, and also important to avoid holding positions into the weekend during this period in time. And fundamentals are important. And, minimally, I hope you understand that from this video. And if you like this video and you want to be updated on how fundamentals impact your trades, hit the subscribe button and the alarm bell to be notified by updates. Thank you so much. Have a great week.